Actually, balancing risk and reward, in the stock market is it's an important topic for both novice and seasoned investor. It revolves around finding the right mix of investments that offers potential returns without exposing you to excessive risk. And so here are some key ideas that would form the basis of this particular discussion. And number one is understanding risk versus reward, understanding the concept of risk versus reward. Actually, risk refers to the chance of losing money or not achieving expected returns when it comes to the the endeavor of investing. So reward is the potential returns you can gain from an investment, and the balance between these two is really critical. It's crucial because higher potential reward often comes with, most of the times it comes with higher risk. So it's like the higher the reward, the expected reward, the higher the expected risk as well. As an investor, your major task is to devise a means of balancing these two extremes. That's your risk as well as you know uh, the reward expectation. Number two is risk tolerance. When it comes to balancing risk and reward, you must first of all consider this particular idea of risk tolerance. So everyone has a different level of risk tolerance, kind of which can change based on probably age, financial goals, as well as the general market conditions. So in this case, we discuss strategies for assessing one's risk tolerance and the importance of aligning it with one's investment goals. All right. So these could be your investment goals. Don't forget the fact that these goals are inherently kind of the entire process is inherently risky. You can't really divorce the rewards from the risk, and so you need to really sit down and critically assess your kind of inborn level of risk tolerance. Number three is diversification. Diversification. So diversification, spread risk across various assets to prevent a total loss of one's investment, a total loss. If a particular investment, tend to underperform. So once you are adequately, you adequately spread out your investment, if a single one of them, underperforms, it won't really adversely affect your overall portfolio or your overall performance. And so in this case, it explains, how diversification across different sectors is necessary. You diversify across different sectors, you diversify across different asset classes, as well as sometimes you may equally diversify across different geographic regions so as to be able to adequately mitigate your risk. Number four is an investment horizon and time frame. Investment horizon and time frame. These factors are very, very important. What exactly is the length of time you intend to give your investment to mature? All right. That's very important because usually when it comes to investing, time, apart from the capital, time is a key factor we consider, and that is very, very important because time will determine the level of compounding you are going to obtain in a given portfolio. And so it's very important we take it into consideration. And so the longer your investment horizon, the more risks you might be able to take, as you have more time to recover from market fluctuations. If you have a longer time horizon, well, you can you have enough time to recover should in case the market, tanks. And not only that, so it equally highlights how short-term versus long-term investing impacts the level of risk one should be exposed to. If you are investing for the long run, where you can afford to take a bigger level of risk. If you're investing for the short run, for the short term, it's advisable you undertake, a lower level of risk. Not only that, number 5 is risk management strategies. What are the strategies you adopt to be able to adequately manage your risk as an investor? There's this particular concept of stop loss orders, to limit potential loss. Asset allocation, to also balance risks across portfolio. So you could place a stop loss. A stop loss essentially means that your stocks will not drop below a particular price, depending on which particular price you fix your stop loss order. If your stop loss order is fixed at, let's say, $5, that means that once your stock approaches and hits $5, the system will automatically sell off your stocks, and so you will not really incur further losses. You may also equally take into consideration asset allocation to be able to adequately balance your risk across your portfolio. So rebalancing to adjust investment over time, based on changes in risk level or goals. You could as well, rebalance your portfolio depending on your risk tolerance, your reward expectation, and the overall goal, as an investor. Number 6 is psychological factors. When it comes to investing, the human being doesn't really act logically or rationally most of the time. Sometimes, psychology will tend to come in, and so we consider some psychological factor when it comes to, the issue of avoiding risk in the market. So investor behaviors can sometimes be driven by emotions like fear, emotions like greed, affecting the ability to balance risk and reward. If one is overly fearful or, overly or somewhat greedy, that will certainly affect, the level of risk one will take, and that will as well, affect the overall, reward expectation, one is likely to obtain. So in this case, we discuss, how staying disciplined and sticking to a well thought out investment strategy can help manage this emotion. And as much as possible, try to keep emotion out of the entire game, out of the entire investment process. Because the more logical you are, the more rational you are, then that will improve your overall result at the end of the day. But if you're investing based on emotion or fear or greed, of fear of missing out, FOMO, all these factors will combine, to increase your risk at the end of the day, and they may not really go well with your return at the end of it all. Please then try as much as possible to drop a comment in the comment section, and don't forget to subscribe to this channel, a channel designed to educate you and make you an efficient, profitable investor that will eventually guarantee you financial freedom at the end of the day. Number 7 is risk, in different asset classes. Risk in different asset classes. So in this case, we explore the risk and reward profile of different asset classes. Classes like stocks, like bonds, like ETFs and commodities have different risk and reward profile. These are things you need to fully understand before you know precisely, which particular assets you want to go for. You need to understand the risk involved, and as well you need to also understand the reward involved in each of these asset classes. So compare high growth, high risk stocks versus stable, lower risk dividend stocks. You want high growth, momentum, high risk stocks. You want to invest in low growth, moderate risk dividend stocks. Well, the choice is yours. It's a function of what? A function of your risk tolerance. Number 8 is the role of research. The role of research. You don't just invest haphazardly. You conduct thorough research before you handpick the stocks you want to invest in. So conducting thorough research, on companies, on sectors and the market conditions can help identify investments with favorable risk reward profile. Okay, so you need to conduct thorough, critical, important, far-reaching research, thorough research, so that you'll be able to, where necessary, possible, pick a high, reward stock or investment that will produce, a lower risk at the end of the day. And so, in this particular context, it's important you take into consideration, fundamental analysis of the asset or the stocks you want to invest in, as well as some technical analysis. You combine both kind of analysis to be able to arrive at the kind of asset class or stocks that will give you the kind of results you want to obtain. Number 9 is in this case, we are considering, real world example. So in this case, we provide examples of both successful and unsuccessful investments, and to demonstrate the balance between, risk and reward. You not only, analyze winning stocks, but you also analyze losers to determine why they appear in the loser category. I also analyze the winners and determine precisely why they appear in the winning category. So the knowledge therein will help you become a better investor. Number 10 is using metrics to evaluate risk reward. You use metrics, standards metrics to evaluate risk reward. So introduce metrics like Sharpe ratios, like Satino ratios, and beta to quantify risk and reward. When it comes to the issue of risk and reward, they are not just they could be quantified actually. Although they may sound kind of qualitative, but they could be quantified. They could be they could be made to become kind of quantitative factors. And so this structure could help you to be able to be in a better position to obtain higher result, better reward, while taking a relatively lower level of risk. Please then try to implement what you've learned today, and I guarantee you that it will help you to become, a well-rounded, better, informed investor, and it will lead you to, a financial freedom you so much desire in the near future.